sales. And so I don't know what he gives them, $10,000 or $15,000, but they'll either starve or they will make $1 million sometimes. Maybe that's too much. Maybe 750. I think 750 is the highest one. Very incentive driven. And so what he's done over the years is, because it's incentive driven, he's been able to weather some recessions because he doesn't have the big overhead that other companies have in their in their payroll. So I think, that's important too. I personally, again, I'm one to have an altruistic, client-centric attitude. I'm probably going to split the difference. If I want a culture of a bunch of high I's and salespeople, I am going to have a heavy incentive compensation, probably 50%. But I'm also going to come up with a handful of team-oriented compensation metrics that every quarter, when the team hits a number, there's a compensation so everyone can work together. Does that answer the question? That we may want to, we could get in specifics in terms of 10, 25, but it's typically based on their base salary. So it's a percentage of their base salary.
So talk details about that, because I think there's a lot of it. Once we figure out the mechanism of incentive, there's a ton of question around the percentage, because let's say that you take a profit pool of $100,000 at the end of the year. And in total, let's call it tripled out net profit. This is money in the bank that you can either draw from or reinvest. And so from that, what are some typical things that you see from payouts based on the bulk of net profit that's available?
Yeah, and so you're going to have some of that profit that's going to need to go to owners and compensate them for the risk that they're taking, right? And then you'll see a percentage of that go to employees, 10 to 50% I've seen that will go to employees. And then the rest, the owner takes it, and rightfully so. They took the risk and they sacrificed a lot, so they need to be rewarded for that. So it can be a percentage of profits, which I think is obviously the wisest thing because it doesn't create a risk. It can also be number of widgets sold, right? So if you want to, one of the creative things to consider when you're first establishing a incentive program is not based on profits or cash, but take the or account for the cash outlay, because it's going to be a cost to you, but give a profit on number of widgets sold. So if somebody sold, X number of books or X number of life insurance policies or X number of cars, give them $50 or $100, because the reality is in the first 90 days, those that have a number of transactions typically will stick around because they're just seeing hope and opportunity and activity. And so sometimes you just have to drive activity, and to do that, it's going to be a cost to you, but you just provide a flat dollar amount per widget sold.
Okay. All right. Good. That is very, very helpful. So we've talked a little bit about incentives. Now what I want to do is I want to switch and maneuver into the wonderful world, the big wide world of taxes. And so we've got this we've got this system. We've just heard about this because we've come out of this presidential campaign. Everybody talks about taxes. And I heard somebody say the other day, you'll never see a flat tax. It's actually John Pollock out of Dallas, Texas, said you'll never see a flat tax because it is not in the best interest of those who are actually writing the tax code for there to be a flat tax, because that's how you can maneuver some deals and do those sorts of things. So let's ask this questions. When it comes to profit season, so we talked about incentives, what do people do with their profits or with their general revenue overall, both at the end of the year and throughout the year? So two different topics here to help limit those taxes so they can increase charitable giving, so they can increase investment in the company, basically pay less from a tax standpoint.
Great question. And in full disclosure, I'm not a CPA, right? But I'm a certified financial planner. I have my undergraduate in accounting and just been in the business world long enough to be able to answer these questions. But in full disclosure, if you had a little guy talking fast, he would say, go see your CPA for all the details. But so it starts with the rule of thumb is don't let the tax decision decide what you're going to buy. I've seen too many people buy a truck at the end of the year. Of course, once you buy the truck, you've got to buy the trailer, and you've got to buy the hitch, and then you've got to buy the boat. And then before you know it, you've realized you've made a very expensive business decision to reduce your tax liability. And so I'm one to not buy something just for the purposes of taxes, and be very careful of justifying purchases for the purposes of taxes. So that's the danger I always see. I like to start with the retirement side of it, and that's my field. But it actually makes sense long term. As a business owner, most of your net worth and most of the investments that you've made over time has been in your business. So, as Warren Buffett says, the best portfolio is an undiversified portfolio when you're right. And so the idea is that I'm going to be right in my business. But what happens is you may wake up 65 and realize that you own a hardware store and Walmart moved next door. And so even though you did everything right, things didn't work out. So my intent is to encourage all business owners to be able to save 15% of their income in some type of retirement plan. And by doing so, it will reduce your taxable income. And so some of the vehicles that I see the most, there's really 3 of them that people use towards the end of the year to reduce their taxable income from a business owner perspective. And one is the solo 401k, which is a great vehicle that allows you to put money in tax deductible. Now, you can also, on a solo 401k, add a provision in there called a Roth provision. And that Roth provision allows your money to grow completely tax-free. You don't get the deduction today, but it grows tax-free. In that account, you can put in $17,500, reduce your taxable income. And if you're over 50, you put another $5,000 in. The other one is this simple IRA. The simple IRA does require you to have some type of matching for any employee. And so you'd have to consider that. But the simple IRA is really nice because there's really no cost. It's like us usually have to have this third party that charges you $500, $1,000 to set it up. The simple, you don't need that. But the most you can put in a simple is $12,500. And then you have to do a little match for your employees if they put money in. Not a big deal to me. That's what our company has. Pretty easy to implement and a way to reduce your taxable income. And then the third one is the SEP, Simplified Employee Pension Plan, and that will allow you to put money in. It's really designed if you're a solopreneur, if you don't have any employees, because anything you put in, it's like a profit sharing. If you put in 20% for you as an owner, you've got to put in 20% for all your other employees. So that could be pretty expensive if you've got a payroll. But it's a really nice one. You can put in quite a bit of money. I think it's $59,000 now that you can put in there, and it can exceed. The calculation is 25% of your profits minus Social Security tax, but it comes out to about 20% of your profits that you can put in. So those 3 are really nice vehicles to reduce your taxable income, put money in one pocket to the other. For a wise decision long term, you need to be saving for that stuff anyways.
Yeah, that's great. It's very helpful. I've got a little image. There's the audit guy coming in now. That's the one that we're all that we're all fearful of. But that's very helpful, very insightful. By the way, one follow-up question on that: Does that money have to be in those accounts by December 31st? Or is there a grace period? Yeah,
so you have until your tax filing deadline on the SEP of October of next year. So that, but the simple and the 401k require a little heads up to the employee. So you have to get those established earlier in the year, in the calendar year. But the SEP is one that can be done by October the following year.
Okay.
Yeah. If you file an extension for your business, you can set it up and later.
Okay. All right. So we've got the tax man coming in, and all of us, as I've mentioned earlier, we want to know how to audit proof our business. So walk us through just kind of a simple, something that the small business owner can understand the best we can to audit proof our business.
Yeah, I would like to know too. But one of the first things to do is pay yourself a reasonable compensation. What happens is many business owners try to justify that their compensation is their salary, however they take out money, is all dividends, which has preferential treatment, right? So a dividend or earnings from a company are not subject to Social Security taxes. So you have circumvented by calling all your income a dividend or earnings. You've circumvented the Social Security tax of 6.2 and the 1.45 Medicare tax. So you have to pay yourself a reasonable compensation and pay Social Security on that. That's where it starts. And this an accountant or CPA or even just good judgment, really good judgment, maybe based on your own research, you need to establish what's reasonable compensation to pay Social Security taxes on. So that's one big one right there.
Let me ask you that with Darryl. Do you recommend that people keep a separate kind of personal checking account that they literally just pull monthly or whatever from business into that?
Hey, Scott, thank you for bringing me back. That's something I don't talk enough about. And that's huge because a lot of people commingle their business and personal. I've always been real clean with my business. I've never mingled my personal stuff with my business stuff. Now, if it's a legitimate business expense, then I will pay it out of my business. But I always separate the accounts with separate checking accounts all the time. So all my business expenses come out of a business account, and all my personal expenses come out of a personal account. Yeah, that has to be done. And then reality, you set aside 25% of your profits into a third account that will be transferred every quarter to the electronic funds transfer payment system, which is the IRS's collection website.
Okay. Now, quick question about that too, because I think there's a lot of confusion when we talk about quarterly tax payments. Does that incorporate federal? Does it incorporate Social Security? What does that include, and what else do we need to add on top of that?
Well, yeah. So yeah, it includes all that, and so that'll get in the weeds of the accounting stuff. But yeah, it'll be your payroll, your FICA, and your Medicare. So yeah, it includes all of it. And the reality is that your first year you just don't know, so you just set aside 25%, and then every year you set aside pretty much the same thing that was the prior year.
Okay, so 25% being a good kind of target around that. I do know that there are a lot of guys who are not doing that. And man, I just want to encourage, along with Darryl, if you're not doing quarterly tax payments, we'll talk about the penalty, Darryl. I mean, at the end of the year, what does that mean to the bottom line?
So let me just tell you what it does. What it means to you is it breaks your back. I mean, I've been a business owner where I've been broke, and then all of a sudden I got a bill from the IRS. And it is so discouraging. And I have so many of my friends who are smart business owners that it has just killed them. You've got to watch that. I mean, I can't tell you how many business owners have made very, very poor decisions by spending the IRS's money. Don't do it. You just have to pay them first. Get in that habit. It's called maturity. You just got to get in the habit of paying them first. And right now, a lot of people want to spend that money, but it's too dangerous. You're playing with snakes. You will get bit. And most business owners that have played that game and have gotten bit say it's one of their biggest regrets of their business careers.
Mm-hmm. Yeah, that's helpful. And again, I think it goes back to what you're talking about. I think we talk about instruments and vehicles. I think one of the instruments or vehicles that is the least utilized is the multiple accounts within a bank account. Basically saying, this is our business account, that's our personal account, here's a tax account, here's a whatever, and just segmenting those accounts. I mean, it's virtually free to be able to do that. For the ones that you've seen, there's another philosophy going around, Darryl, right now about this idea of profit first. So basically taking the IRS, taking your profit and starting to funnel, pay the IRS, as you mentioned, through an account, but funneling your profits first before you pay anything else. Do you know anything about that? And if so, what's your take on it?
Well, yeah, I mean, that makes sense. It's everything has order. When I get up in the morning, I have to put on my underwear and then my pants, right? So money's no different. There's order in it. And so, yeah, you would when you would ideally direct all of your revenues, so right, your sales to your business account. And in my world, and people can do it different ways, but I would direct it all to their business account. And then I would pay myself a monthly amount each month. So I would transfer a specific amount to my personal account to cover my personal bills, and I would leave the rest of the cash in there to cover the variable expenses that come out. And then at the end of the year, I would take out my excess cash or profits. And I say or because I may not take out profits if I don't have enough reserves. I want to make sure I always have enough reserves, and typically 3 times your monthly expenses. So I'm not always going to take out profits. Many times I build up reserves because downtimes come. And if you don't have enough reserves, you're going to be hit. And I want cash, and I've got a lot of cash. I want it because I want two things happen. Downturns happen, and a ton of millionaires are made in recessions. And I will tell you specifically, I made a ton of money in 2008. because I had some cash and I bought a business. And so when the next recession comes, I want the cash to buy stuff. And I call that angel vulture. I want to be an angel vulture. I want to help somebody out who's trying to get out of a bad decision. So I'm a vulture, or I'm an angel, right? But I'm also a vulture because I'm going to pay a deep discounted price. So that's why I'm not taking profits first. I'm keeping some reserves as well.
That is brilliant. I think I've got a friend just up the road from you in the Dallas-Fort Worth area. And when the high times are here, like now, he's not buying anything. He doesn't buy anything. He's in commercial real estate. But as soon as there's a dip, he's ready. He's ready to rock and roll. And to your point, there's always value in that. It's funny you mentioned the vulture thing. My wife's a fourth grade teacher, and they just learned about the turkey vulture. And this is I'm outing my wife here, but she came home telling our family about the value of the turkey vulture to society and started crying, like tearing up about it. She was so amazed that God would, in his infancy, create essentially a flying garbage can, to help us so we don't have all this stuff around. And it's to your point, not calling you a flying garbage can, but the reality is there are people in that moment, they need liquidity. I mean, they need cash. And if you're not there to help provide that, again, at a deep discount, but everybody understands it at that point, then you're not helping them either. I love how you put that angel investment idea. I think that's very, very wise. So here's one of the biggest things, and I want you to reiterate some of these things, Darryl, as we're going into this year. And in January, I'm going to sit down with some guys. We've already started doing forecasting, obviously, but we're going to sit down, and this is going to be the year of the dashboard. So I want you to walk us through, if a small business owner is the pilot of their little plane, and they've got a set of their panel that is the financial panel within their cockpit. What are the 2, 3, 4, 5, 6 instruments within that financial panel that they just need to be keeping eyeballs on a regular basis throughout the year?
Yeah, so that's a tricky question, but I'll do my best to answer because, right, there's all different kinds of business, and there's all different kinds of instruments that I would look at. But I definitely want to keep an eye on my, if I have staff, I want to keep a staff ratio relative to my revenue. That's always important. So,
Darryl, break that down because you've got something called labor efficiency that I've used over and over and over again. I want people to be able to hear how you describe what a labor efficiency number is.
Yeah, so the labor efficiency ratio is established. Really, I reset it every year. So it's the amount of compensation, total compensation it takes to operate our organization with the current labor that we feel we need. So if we need 18 employees or 17, I'll establish that, and I'll compare that total number. That'll include health insurance and everything. That total number to our estimated revenue. And so if that number is, let's say, 25%, then I will provide that I provide that number to my chief operation officer, and she knows that she cannot come to me and request more staff if she's above that 25%. So what used to happen was she would come to me periodically and say, we need to hire somebody. We're underwater and we've got a lot of work. And I would have to say, well, we don't have it in the budget. And I would get this all the time. And then I said, I'm going to stop telling her that. I'm going to let her make that decision, and she'll see. I provide the revenue number, and she does the math, and she says, okay, we can afford somebody or we can't, because the reality is that innovation happens in constraints. And so I want her to think of other ways to be more efficient than just hiring somebody to solve a problem. And so she's been able to do that over the last couple years since we've established that labor efficiency.
All right, so I think this is brilliant. I've talked a lot about it. Here's the way I've used it, because I use this all the time. It's your all-in payroll divided by your total revenue, and you take that number. It's going to give you a percentage. You mentioned about a year ago that number for you was around 21%. What we're finding in businesses that are high cost of goods sold type businesses, home builders, contractors, that number typically goes down significantly to a 5 to 12% range. And then we're also finding businesses that are high, what I would call knowledge work businesses, architects, engineers. Those numbers are a lot of times well over 21%, could be in the 25, 30, 35% range. Is that still kind of a target that you're looking at?
It is, yeah. And that typically doesn't include owner's comp. So that's something to consider as well. But yeah, that's about right. And Scott, I think you've done an excellent job just telling me what with it, and you exploring that relative to other industries. Over the last month, I've just worked so hard in my business. I haven't benchmarked that with others. I just look at my own. And so I think that's going to be very helpful for others as you continue to explore how that looks in different industries.
Yeah, and even how I've seen it flesh out, Darryl, because I'll get this question all the time. When I introduce it, I'll say, hey, a friend of mine, Darryl Lyons said, and they look at me, instead of going, wow, Darryl Lyons said that, they look at me cross-eyed and go, well, what does it mean? And so what I tell them is, your number today doesn't mean much. But what it means in light of the previous numbers and the future numbers, it's a barometer. It's like checking your pulse. If you're historically at 68 beats per minute and you come in this month at 66, next month at 69, cool. But all of a sudden you're at 92. Now we know something's awry that we need to look at. And so that's how we've used it to see it play out. All right.
Well, that's right. I'm sorry. It just says, to your point, the only reason ratios work is if you benchmark them against others or compare to prior years. And so you have to give them time for them to really provide value. But once they do, you'll never go back.
Absolutely. That's great. So let's call that the labor efficiency ratio, more so to just benchmark. So that's one of the items that needs to be in the dashboard. What else?
So I often like to look at leading indicators, things that drive things that you can't control, right? So how many, and this is pretty simple stuff, but sometimes we get away with it when we get successful, but how many phone calls yield certain transactions, which ultimately play a role in revenue. And so you want to make sure you have at least, typically it's one. You know, I used to always say, when I was starting out in the life insurance business where I learned a lot of this stuff, I used to say 3 calls a day kept the creditors away. 3 a day keeps the creditors away. And so I would make 3 calls a day. And that was the one thing I had to do every day that increased the probability that I would meet the financial numbers I needed to pay the bills. And so we need that one leading indicator, and that has to be on the dashboard. And it could be phone calls, or it could be referrals, or it could be site visits. Whatever that one thing is that needs to be driven in. The leader's responsibility is to be the chief reminding officer, to not just put it up once and walk away, but to constantly drive that in a way that's everyone's rallying behind it. It's not a dictatorship. It's everyone realizes that this is what's needed to be successful, and this is what we need to know that we're winning. And ultimately, people like to be a part of winning organizations. So to me, this number needs to be about a 75% chance of success.
Absolutely. I love that. I even wrote that quote out in our notes: be the chief reminding officer of your business. I tell our clients all the time, you need to be the CTO, the chief training officer, but I like that one better because of my very first manager always told me, Darryl, he says, his name's Skip Clarkson at Pfizer. He said, Scott, repetition is the mother of all learning. Repetition is the mother of all learning. He'd say it 3 times in a row. And that was 2001. He told me that. And obviously it's never left me, but you are absolutely right, because it's true. Repetition is the mother of all learning. And so you keep reminding, keep revisioning. You know, that famous story about Nehemiah when he cast the vision and he came back, I think I heard somebody say 26 days later, and recast the same vision.
Yeah, that's good.
So,
that's
all
great.
Right, so we've got the labor efficiency number. We've got a couple of key indicators to keep kind of reminding ourselves of where it is we're going, that vision, the mission, sometimes about those key indicators. Anything else?
So I typically like to look at my marketing cost, and I'm encouraged there. I've run about 6 to 7%. And I really, frankly, like to look at most ratios. And the reason I do, and I'm going to go back to marketing costs, but the reason I do is because it's encouraging to me. Let me give you an example. And again, I'll come back to marketing, but I looked at my rent. I just signed a new lease in San Antonio, and it's in the nice side of town, and it's very expensive. And I thought, holy cow, what did I get myself into? You know, it's real adult dollars. And then I looked back at our prior lease, and the rent was much less, but relative to our revenue, it was less, this new lease agreement. And so that put it in perspective, right? I was like, okay, I get it. But the only way I would have known that is by examining the ratios relative to revenue. Marketing's a great one to look at too. And marketing's a great one to also ask your friends and not competitors, because that one's fun to just have conversations about how much do you spend on marketing relative to your revenue, and some will say 4%, 6%, and people are usually willing to give that one away. It doesn't take too long to figure out, and then you kind of just plan accordingly, because it's so easy to spend a lot of money in that space. And when you give yourself some boundaries and rules to play within, you can freely spend the money. And then not necessarily overspend or underspend, because there's some stuff in that marketing space that just takes a long time to materialize. And so you need to give yourself some range to work within to be patient for your marketing to work.
So I want to highlight a friend of mine, Derek Champagne of the Artist Evolution out of North Arkansas. He actually put a great little spreadsheet together. 2 to 3% is what he calls a very, very safe marketing budget. I think it's a 6 to 8 or 5 to 6% is kind of the next level. A 13% and higher is hyper aggressive, like teetering on the edge of, chaos and kamikaze-like behavior. So that just gives you a little framework for anybody who's listening, that if you're within that 2 to 3 range, man, you are super, super safe. But if you're kind of 5, let's call it 5 to 9, that's when you're starting to, you really need to pay attention to where those dollars are going. And frankly, with the 2 to 3%, you need to pay attention to your point with the ratios of what is our ROI? How do we even measure that ROI? And I'm still so shocked at how many people put significant 4 and 5 figure dollars into mediums that are very outdated, that they cannot get they can't get metrics on. And so you might put something in a magazine, nothing against magazines, it may be very, very effective. But you got to at some point figure out how to get metrics on those things so that you can run those ratios, or else you have no idea. And I don't know that that's a very good stewardship of your money.
Yeah, it's a great point. And you get to the point where you some of it's going to be marketing, where you're going to need direct results, and others going to be branding. And the branding takes a little while, and you have to be very intentional about it. But again, knowing your numbers, you can make better decisions and eliminate the ones that aren't working. But yeah, you could probably unpack that conversation. I was kind of intrigued, and I almost wanted to go there, but the marketing that doesn't work anymore, and the forms that do, and we're trying to figure that out right now as a company, and trying a lot of different things. And it's really interesting right now. It's a fun time to be investing in marketing, because there's a lot of change happening, and a lot of trial and error, and there's money that's burned, and you just, as long as you keep it within your budget, you have the opportunity to do some R&D.
It used to be the time where the safest job in a company was marketing, because all you had to do was follow the formula, right? Call the television, call the newspaper, call the magazines. If you spent X, $100,000, it equaled this kind of return on, et cetera. It just doesn't happen anymore. Darryl, you told me something about a year ago that was really fascinating to me. You said you look at your cash balance. I can't remember if it's once monthly or once weekly, but I want you to reiterate why you do that, and why you think that also should be a part of a regular financial dashboard.
Yeah, I look at it every Monday, our company cash, and I look at the transactions, because I want to make sure that nothing funny is happening. I have other people that have access to my bank account, and I just want to make sure there's nothing. I check on checks that have cleared, and it takes me 5-10 minutes just a once over real quick, and so it doesn't take that much. But I want to keep enough cash on hand. That number does vary, typically 3 times your monthly expenses, sometimes up to 6. And it all depends on the kind of business that you're in. We have a reoccurring revenue type of business, so our cash need isn't as deep as businesses that are, commercial real estate, where, it's feast or famine, right? You need a lot of cash. And so I find that when you take inventory of the businesses that are truly successful, they keep a lot of cash on hand, and the business owners aren't drawing too much in that cash. And so I'm going to have 3 to 6 times our monthly expenses in cash typically, and that does vary.
That's great. That is very helpful insight. And you said that a few people have access to your bank account. Those are the ones you know about. There are also a few other people who have access to your bank account that you don't know about. We just had a $717 charge to our business account about 3 weeks ago. We had a $500 charge about a week after that. Had no idea where they came from. And it's yet another reason that, frankly, you need to keep eyeballs on that stuff, because sometimes your bank's not going to pick up on that. And there are cyber criminals everywhere. I know this because just a few weeks ago, we had a client that got drilled in the 6-figure range by a cyber criminal, and it's a bad deal. It's a bad deal. So you do need to keep eyeballs on that. Well, Darryl, this has been just awesome. This is why I contacted you, is because I wanted to hear your insight on it. You have such clarity around all of these issues. This is what I appreciate about you, and not to get too mushy, but you've got a handle on the financial side of it, but you also get the small business mind. And that's what because there are a lot of guys who get the finances, but they struggle with the small business mind. And I think you get both of those. And that book right behind you, Small Business, Big Pressure, you did not ask me to plug it, but I'm going to plug it. You, by the way, you don't know this, but you have made our 2017 required reading for our client on their book, on our book list. So later on in the year, but you've made that, and I would highly encourage anybody else listening, make sure to go buy a copy. I assume they can still get a copy, right? Amazon or something?
Yeah, absolutely. It had a great year, and I don't know, maybe you can still get it for Christmas.
Yeah, I just ordered a book yesterday, and it'll be here by Wednesday. So no doubt, especially if you live like in LA or San Antonio where they're flying drones or whatever to get
I know
that thing to your house.
Yeah.
So Darryl, this has been phenomenal, man. Thank you so much. Merry Christmas to you and your family, and thanks for spending the time with us.
Thank you. Merry Christmas. Appreciate it.
All right, guys. Hey, it's been Scott Beebe with the Business on Purpose platform, my buddy Darryl Lyons. And this is our first time on Smiletime. Hopefully you guys have gotten it through Facebook Live. We're going to take this audio and put it in podcast form as well, so you'll be able to get that there. So I'm going to click the offline button, and we may have to mate just a little bit, Darryl, because I think we're a little bit behind. And so give me just a second. First time we've ever done this. All right, give me about 15 more seconds. All right. Merry Christmas, everybody. All right, man. Man, I'm pumped. I am so pumped. I hope that worked, because if it did,